S&P 500 stocks are signaling a 10 to 15% drop is coming. The charts say it's going to be much worse. Are you prepared for what's coming? Stay tuned. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, negative market breadth of this magnitude is rare and dangerous. This past month, we saw 70% of trading sessions end with more S&P 500 names declining than advancing. This is a historic warning of a major crash to come. And with investors crammed into U.S. equities, the risk of a correction, or even worse, an all-out crash, couldn't be higher. We're going to show you everything you need to know and what you need to do right now, because this is our Sunday show, the show that makes you money, where we like to look at the technicals, momentum, and machine positioning to help you make more money trading and investing. And we've got some great chart setups for you to show you how you can control your risk. Now let's head over to Goldman, where we picked today's story. For those who have been away from the screens, bears have increased the volume, technicals are taking over the narrative, liquidity is challenged, and a healthy dose of risk prudence has just started, meaning people are starting to increase their short positions. But we already know liquidity is challenged. We talked about that just yesterday when we look at what's going on in the banking sector, but we're right in the middle of the corporate share buying back blackout window. And with corporates, the biggest buyer of equities, they're in the dark right now, meaning liquidity is challenged. But what Goldman's indicating here is that technicals are taking over, because this has been a momentum driven market. Momentum is rising. It means you just buy the dip. It doesn't matter. You just keep buying. But what we're seeing underneath is the breadth, or technicals are weakening, suggesting a 10 to 15% drop is coming. But as you're about to see when we look at the charts, it could be much worse than that. Goldman goes on to say they've seen a significant decrease in market breadth, with 70% of the trading sessions in December saw more S&P 500 names declining versus advancing. And negative market breadth of this magnitude has extremely fat tails, meaning stocks go down, and yet the S&P 500 index has been extremely resilient versus the regression. And based on Goldman's research, this suggests stocks could drop 10 to 15%, because what's actually happening underneath here is we're seeing the soldiers, the rank and file of the S&P 500, they're falling off. Their stocks are declining in value, but at the same time, we're seeing the Magnificent Seven. They're commanding lots of money. They're holding the market up, but where the soldiers go, the generals eventually follow. Let's take a look at some market breadth charts here. We're going to start out with the percentage of S&P 500 stocks above their 50-day moving average, which is at a scant 24.3%. Now, if you're not familiar with what this means, we take an average of a stock over its past 50 days, and we look to see if price is trading above, which is considered bullish, or below, which is considered bearish. And the more stocks that trade below the 50-day moving average, well, it means those that are still hanging out above are likely to fall. We can look at this chart. We can go back to April, and what do we see? Breadth is declining. And what happens with a lag? Well, the market comes down. We can see it happening now. Breadth is in a very extreme dangerous level, indicating that unless a big buying surge comes in, and keep in mind, corporates are in blackout here, institutional money managers are all in, retail is all in, everybody is in this market, including machines. The risk now here is squarely to the downside. But when we look at the percentage of advancing stocks, we can see there's been a surge here coming out of the end of the year, where Goldman was warning that something could go seriously wrong. The problem is, while we've seen a surge in stocks advancing versus their decliners at the tune of nearly 80%, it has not led to a big upturn in the market. And if this rolls over, the risk could be high, because what it indicates, according to Goldman's research, is we could see a 10 to 15% decline, but an all-out correction could cause stocks to go down even more than that. We'll make the case for that, but let's take a look at this next chart, which is the percentage of S&P 500 stocks above their 200-day moving average. This is currently at 56%. Now, we think of the same concept. We now look at stocks above their 200, which is again considered very bullish, or below. But the problem is, as stocks fall below their 50 and then eventually their 200, it tells us they're headed into a bear market. The risks here are high, because when we go back to 2007, we saw that there was a high percentage of stocks above their 200-day moving average. It started to slow down, and next thing you know, what started as a correction ended in a bear market. We can fast forward to right around 2011. We see it started to roll over. Stocks started to fall with a lag. We see it again happen around 2015, where we saw that massive double dip bottom again in 2019. And look at now, every time we see a slowdown where breadth falls below the 200-day moving average, it starts to accelerate to the downside. What it suggests is stocks are coming down, and it's not likely just to be 10%. Because right now, when we look at the machines, we see S&P 500, they're in a neutral standpoint. They're long the NASDAQ, and they're neutral on the Russell 2000, meaning we've watched the machines leverage up. And the reason we talk about machine positioning every week is because it's absolutely critical to have this information, because when the machines are in long positions, as we broadly see right now, as breadth starts to fall and prices start to go down, the machines lock in their gains and sell. Meanwhile, a lot of investors will look to buy the dip. What they don't realize is hundreds of billions of dollars are going to get liquidated very quickly as these machines cut and run. But let's start out by taking a look at the S&P 500. Again, Goldman says 10 to 15%, and make the case why it could be a whole lot worse. Momentum is negative, but how do we know that? Well, we start out with a relative strength indicator, and it's at 47. That actually indicates momentum is positive. But we look at the MACD, or moving average convergence divergence. This has a negative cross, but we add a third indicator here. This is a proprietary indicator we use in our Momentum Timer Pro report that looks at these technical indicators, but we add a proprietary overlay. It's saying right now momentum is negative. In fact, we have 5 consecutive daily sell signals. That is an early sign that we're seeing momentum move to the downside, and the stocks could come down. Now, Bank of America knows the machine positioning is neutral. Well, we run machine positioning and trade that as well. We see on our fast algorithm, it's got a 15% short position, indicating that Bank of America is likely to see their machine sell, which will cause a wave of machine selling. We see here on the slow algorithm where a large amount of money is traded. They're still long, but slowly scaling back. You'll note we don't have a position on this from a trading perspective. We see there's opportunities elsewhere, but let's take a look at the charts here in terms of what is likely to happen. And let's zoom out to the 5-year chart, because I want you to see what's been happening is stocks have been climbing this trend line, and that's momentum. It just says buy the dip. Every time you just keep buying them because stocks only go up. But coming back out of the pandemic, what happened? Stocks went on the same tear, only to get back about 2/3 of that. Well, what happens is stocks comes down. People that previously bought those dips, they get stopped out, or they don't want to be in a lost position, so they sell. Then you see traders come back in, and people say, you know, I'm not convinced. Then the selling wave hits again. People again flushed out, and you see this happens until it's all finally over. The risk here isn't that we see a 10 to 15% drop, because if you look here to the right in green, what do you see? Volume, and there's not much here. The first volume support is around 470. The bigger support gets here in around the 450 to 440 range, suggesting that if we go into an all-out correction here, it's going to be far worse than 10 to 15%. But if you're looking to trade momentum or trade against the machines and win, check this out. We walked into the weekend with 100% win rate across both of our reports. If you want to beat the market, if you want to get that edge, we show you how to trade against the machines and win, because when they're buying, we want you to be in before them, and when they're selling, we want you to get out ahead of them. And if you're looking to trade momentum but you struggle with it, because a lot of people do, we make it so easy, and we're going to make it even better. And if you want to jump in, we've got a 30-day free trial. People asked me to extend it for both of the reports, so we did. You get the reports, you get the signals, you get my opinions on every trade. We back tested it to validate that our reports are winners. We give you risk control levels, and here's the best part: not only do we update it every week, but I tell you exactly what my trading account looks like, so you can trade ahead of me. You want to buy before I do? You want to sell before I do? I'll tell you exactly what you need to do, because right now I'm beating the market, and you can too. Grab those links in the description below, because breadth of the market's changing, and there are opportunities in the market to make money. You will show you exactly where they're at. Let's take a look at the NASDAQ here. As we look at the percentage of stocks above their 50-day moving average, it's now down to 37.6%. And we can see that as breadth goes down, and keep in mind, this is looking at all of those stocks in the NASDAQ that people don't pay attention to, because everyone's fixated on the top ones. What do we see? That as breadth goes down, price eventually follows. This is very critical. As Goldman notes, we're seeing the markets shift from a momentum perspective and now focusing on technicals, which are getting worse. And we can see as the RSI has been cooling off to 51, but still positive. But we know that momentum's overall is negative. MACD's got that negative cross. Our proprietary indicator on Momentum Timer Pro, it's negative as well. And that's popping 4 consecutive daily sell signals. We think that's going to ramp up again. But keep in mind, we don't have a trade on this. Why? Because we think this is going down, and we think there's better opportunities elsewhere. elsewhere. You can see from a machine positioning, our fast algorithm is selling down, our slow algorithm is selling down. And looking at Bank of America's data, said this long, well, our data, because we look at a historical overlay, suggests the B of A is going to be net sellers here. Let's take a look at the NASDAQ 100. What do we see? A very similar chart to the S&P, a big rise in momentum that when we look back led to a big sell-off. That's the risk here, because when we zoom in, let's take a look at this 2-year chart. What do we see? There's a little bit of volume here coming back to what we saw was the yen crisis when the carry trade blew up. But beyond that, you don't really see volume over the past 2 years till down here in this 370 range. Keep in mind, close at 518. Again, you want to know why we don't have a trade on this? The risk to the market when you get these extended momentum runs is comes to the downside. Again, you want to look at what you can do to hedge your portfolio, or even protect your portfolio. Jump on our subscriptions. We'll show you exactly what to do. Plus, we got an interesting trade setup. Stay tuned for that. Let's take a look at small caps, because I think this thing is going to come crumbling down. Look at our machine positioning. Max short on our fast algorithm. We have 15 consecutive days of sell signals. That means momentum clearly now heading into the oversold territory. I think this is coming down. The charts are giving us maybe a slight different perspective here, but let's take a look at what's going on with small caps, because this is critical. We talk about where the big caps go, where they're going to follow the small caps. Now look at momentum. We have a hit oversold territory on the RSI. It's bounced up a little bit, but how about the MACD? Still deep and oversold, looking to get that positive cross. It's not there, but something that did happen is buyers stepped in here, right at that 6-month volume profile. That's what that red line is here, and resistance is right above it. That's a risk. You go back and you see resistance right at that purple line, and that's what's called a supply zone. That's where sellers are at. They've been dominating there. Buyers have been coming here right below. The question is, when do buyers run out of fuel? And when they do, watch out. You're going to hit that 200-day moving average here and right down into the supply zone. We'll zoom out to the 2-year chart. You can see that this is the last zone where buyers were really at. You see the battlegrounds right here in the middle. Look for a pullback down to here. If that doesn't hold, then the risks are all out squarely down to 185. Keep in mind, we traded 224 on IWM closing out the week. All right, let's keep going, because we've got the banks. Remember, people are bullish on the banks. We said, no, this is not a good time. Rate cuts are not bank bullish. What do we have is 18 consecutive daily sell signals on XLF. But look at this. On the 1-month window, we have a sell max. And this is critical, because when we're trading momentum, we look for these big downturns in momentum and look for shifts on them. And here's the best part. We back tested the report, so we actually know what's going on. And I give you my opinions on the trade, so we give you an extra overlay on that. Right now, we have no position in this thing, likely to head down to 47.10. Let's take a look at XLF. If you want to talk about something to avoid that a lot of people bought in, this is a chart. And how do we know this? Because see this red line? This is a 21-day moving average. And how do we know we're seeing a bear market begin? Because when you get a cross of a moving average to the downside and it reconfirms the bottom of it on the downward trend, that's a bearish signal. It's made its first cross on the 50-day. It bounced up and it's failed there. This is setting up for a negative move. Look at momentum. MACD saying, look, I'm not ready to make a positive cross here. We see a little technical bounce as traders came in. Look for that to roll over, and it's not the only one, because let's take a look at the regional banks, and what we're seeing is the same scenario. 18 consecutive daily sell signals. We got a big sell max on the 1-month window, and I think this thing's going down. Our downside target 52.36. I think that's going to be a whole lot worse than that. Let's take a look at KBE. What do we see? Same scenario here. A cross of that 21-day, a cross of the 50-day. Look for it to reconfirm that 21-day on this move down, and next thing you know, you see it coming right into support where those 2 purple lines are. We zoom out, and if it doesn't hold there, you got major support is way down here at 45, so we could see a significant decline and unwind in the regional banks coming. But let's talk about the bond market, as everyone's bearish on it. In fact, we're down 7%. Now, we encourage everybody to use stop losses, but what if you don't? What if you forget? It's okay, and you get upside down, use the reports to dollar cost average in, and look at this. We're 100% short on our fast algorithm and our slow algorithm, and this is setting up when these reverse, we're likely going to put a trade on. Our subscribers will know, and I think there's going to be a huge opportunity to trade the long bond and make some money here, and that's exactly what we do with our reports. So look at momentum. We've got 15 consecutive daily sell signals. Momentum on the 1 and 3 month are both negative. This is fantastic because we'll be looking to add to this trade. We're going to keep dollar cost average in, and then when it hits positive, we can either sell or ride this thing higher. Let's take a look. Upside target 89.97. Well, I revised that down, and for a good reason. It's not ready to go, but let's take a look at TLT here. You can see it's pulled way back down here, but let's zoom in. Do we have any support yet? And that to check is the 10-day chart, and you can see price is just below the 10-day volume profile. So there's a bottom here, but it's too early to call. We're still saying it's still going to rally up here into the 89 range at some point. But again, this is in the early stages of a potential bottom. We'll need some more data, maybe another few days or a week. We'll see what happens on that. But let's continue on because we've got gold, and a lot of people are bullish on gold. Charts are saying potentially otherwise here. Relative strength index at 50. MACD's got a positive cross. Even Momentum Primer Pro says momentum is positive. But wait till I show you the charts. Because what we see in machine positioning is they could be buyers here, but we're seeing a couple buy signals on momentum after a string of sell signals. What does the chart tell us? Is this a bullish setup, or is this one to avoid? Well, here's the risk. If we look at the 6-month volume profile, this is where most of the shares have been traded over the last 6 months. You see sellers above, buyers below, and right now buyers are not strong enough to break through the sellers. The sellers are taking advantage of every rally in price to sell. And look at this. It crossed the 50-day moving average and came back up, tried to cross it again, and now it's running to resistance on a downward sloping 50-day. This is a square risk to the downside. This is something you probably want to avoid, at least for now. But let's talk about GDX, because if you're bullish on gold, the miners give you a far bigger leverage play on this. And look at this, our fast algorithm. 15% short, our slow algorithm 100% short. So opportunity could come here, and we see momentum, a big sell minimum on the 1 month. I think that could get worse here. Let's take a look at GDX and make the case of why the miners better opportunity than metals, but this is a technical bounce. If you want to see one, let's zoom out, not to the 5-year chart, but how about the 2-year chart? What do we see? This is a place where buyers have been at before, and guess what? They came in and bought. The problem is they didn't get a big lift here. Normally, they get some acceleration off of this bottom, and maybe the key is not to buy the first touch of this as you go back and see. We told our subscribers to pass on this one for now, because let's zoom into the 10-day window, and what do we see? Price is holding its 10-day volume profile, meaning there's people that still want to get out here. So the opportunity for GDX maybe is not just yet today. Let's zoom out again back to that 2-year chart. If price doesn't hold this level, it's coming down to 31.17. That would be a much better entry point. And if it gets down to the 29s, you're talking about some major opportunity. Let's continue on, because it's not in the miners where we see the play. It's uranium. And momentum is positive here. The RSI is at 47. MACD's got a negative cross. This has got one daily buy signal on Momentum Timer Pro. But look at this. We're seeing buying coming off of that max short window. We see a flip on the momentum from a sell max. And these are great signals. But what did we tell our subscribers to do? We told them to trade it if they want it, because this is a short-term setup. If you're looking to make a quick buck, let me show you your rating, because this could be a fantastic setup for you. Let's zoom down here to uranium, and what do we see? Right into a supply zone. You can see it comes down to supply zone, buyers come in, supply zone, buyers. So every time it gets between 27 and 27.60, you see buyers step in, except way back here. So the risk is it was going to rally up, and how high could it go? Let's zoom into the 6-month volume profile. Upside target, we told our subscribers, 29.68. Trade it if they want it. If you're lucky, you get a breakout to 32.75. But this is a very technical setup. Maybe one even to consider using option trades on, but however you do it, keep in mind this is a short-term trade. Upside 29.95 with the target breakthrough from there 32.21. But so far what we're seeing is market breadth is declining in a big way. This is setting up for a potential 10 to 15% crash based on Goldman's research. But we look at the charts and look at where volume support is, and keep in mind we're in blackout from corporates all the way to the 20th. It's setting up that something much worse could come. Opportunities are out there. Be sure to jump on those links in the description below for your 30-day free trial while supplies last. With that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.